Very historic week. Meantime, stocks are rallying here on the back of the Fed's rate cut. Our next guest likes industrials and financials here. Fundstrat Global Advisors head of research and CNBC contributor Tom Lee joins us on the phone, sticking with his target of 5,200. Tom, I know you agree the cycle has started and there is a Fed put in place, but it doesn't sound like you're willing at this moment to add a lot more risk.
Good morning, Carl, and thanks for having me. You know, Carl, I've got, I think, two time frames. I think what Steve said about the recalibration is really important because I think investors also need to recalibrate. There are too many that were in the camp of a hard landing coming, or the Fed would be too late. And this Fed cut cycle, I think, is setting the stage for markets to be really strong over the next 1 month or next 3 months. But what the stocks do between now and, let's say, the election day, I think is still a lot of uncertainty. And that's the reason why I'm a little hesitant for investors to dive in. But if I was going to advise where to be positioned, Carl, it's exactly what you said. It's cyclicals, which is industrials, financials, and small caps.
Right. With a preference for that over your traditional Mag 7 tech AI build-out trade?
I think tech and Mag 7 still keeps up with the market, and that's why if someone owns it and they have tax implications, I wouldn't sell it. But for all these folks that have been sitting on defensive positions or thinking the Fed cut was going to be too late and the market was going to, equity markets were going to fall, I think those folks have to allocate into cyclical stocks, especially small caps, because they are not only sensitive to the cut in rates because of variable rate debt, but they're going to benefit from the cyclical boost to the economy as mortgages, the cost of mortgages drop, auto loans, credit cards, the lift to the consumer, potential M&A. All these are big tailwinds for small caps.
I guess then the risk to this, Tom, is that inflation comes back, right? If you're talking about this big cyclical recovery because of what the Fed's doing.
That's true. But I think one thing investors have to distinguish is that real growth, like GDP growth, doesn't mean inflation pressures, because inflation is, a mismatch of supply and demand. And I think there is a lot of excess supply potentially coming. For instance, housing could have a supply response. And if you look at the two biggest drivers for inflation for the past 8 quarters, it's been shelter and rent rolls and auto insurance. And auto insurance, I think these insurers have reached sufficiency, so you're not seeing the premium increases anymore. So unless the rest of the CPI basket accelerates, inflation is actually falling pretty sharply.
Hey, Tom, on the labor market, we're going to get 2 prints before the November meeting. Some of these doves are arguing that labor is going to force a faster pace of cuts because historically they argue the change in monetary policy doesn't get felt in the labor market for 4 quarters, and the peak impact is not for 8 quarters. I wonder if you agree.
I mean, I don't think there's anything wrong with people looking at the history of labor markets, especially as people know, as labor markets slow, it has a cycle of its own. The one thing that I think we have to keep in the back of our minds is that CEOs have been cautious for the last 2.5 years because the Fed telegraphed a tightening cycle to fight inflation. So I think that the fact that rates and now we're in an easing cycle means that companies are going to actually start doing expansion. So I think the labor market and the Fed is mentally knocking down these monthly numbers. I think tailwinds are emerging for labor markets to actually strengthen.
Yeah. Well, claims would definitely back you up today at 219, even though some argue about seasonal distortions. Tom, look forward to talking in person soon. Tom Lee this morning.